All right, we'll go ahead and get started here. So welcome to the Q3 2024 Financial Performance Webinar. A quick disclosure to view, this is not a research report or investment advice. All opinions expressed in the webinar are those of our presenters, and past performance is not indicative of future results. So welcome today. We're thrilled to have you all here. If this is your first Q3 2024 financial performance webinar, welcome. It's our first as well. So happy to jump into a new quarter with you all and review all the data. Our presenters today are Ryan Frazier, our CEO and co-founder, Cameron Wu, VP of Investments, Jake Pruchno, our head of operations, and then my name is Korin Hedlund and I lead our investor relations team. A quick agenda to give you all a lay of the land. Cameron will walk through Q3 2024 highlights, which includes details on individual properties, fund investments, and then Jake will walk through dividends, share prices, an exciting recent sale that we've had of a property, and then Ryan will jump into what we've released within the quarter, as well as what is to come on our roadmap. And then for folks that are newer here, we jump into Q&A. So this will be based off of questions that we see come through the chat. So we will tee those up for after prepared remarks. So they won't be answered during prepared remarks. So keep it coming in the chat. We'll either answer there immediately or we'll tee them up in the queue. So excited to have you all here. I'm going to turn it over to Cameron to jump right in.
All right. Thanks, Corinne. And thank you, everybody, for joining. Excited to go over our Q3 results with y'all. So first, an overview of our portfolio at a high level. We have 409 individual properties. So that includes both long-term rentals and vacation rentals. There are 47 single-family residential fund properties. They are operated as long-term rentals. So that brings our total home count up to 456. And we also have 43 active loans earning interest within the private credit fund. And those 456 properties represent about $200 million of funded property value. So kudos to everybody out there for being part of our investment community. This is an overview of our arrived kind of property and asset distribution. We have added a new icon to this map, which are our loans. And there's a couple things that you can glean from this picture. We used to only have the blue dots on there representing where our properties were, but now we've got loans as well. So you can see that we're pretty concentrated in the southeast portion of the United States with respect to our home assets. And that's because there's it follows the investment thesis of having new inventory, a low cost of living, a reasonable entry point, in a growing population with good infrastructure. So the southeast part of the country fits all of those criteria. And we also have select investments in Mountain West regions like Denver, Salt Lake City in Utah, and have a few properties in Texas now as well. On the loans, you'll see that we are pretty diversified from a geographic point of view. And the interesting thing about that is that debt is a very different asset class than equity. So when you're investing in a home, you're looking for both a good dividend yield, so good rental income, plus the potential for appreciation. So we're really, really strict on kind of targeting that optimized set of geographies that we think long-term rentals will really benefit from. But with loans, we're getting into areas that we might not invest for single-family residential. So it's a much more binary outcome with debt because you're looking to get paid back. You're not looking for the top part of appreciation, which is hard to forecast, but debt is a lot more deterministic. You have an interest rate that the borrower is going to pay you. You have very little to no expenses as a lender, and you're just looking to get paid back. That's the ideal outcome. So we have investments in, you can see up in the Seattle area, a couple in California markets, some in the Northeast, like in the New York area. So, loans are a really nice addition to the entire Arrived investment portfolio because we can start spanning more geographies. There's always good investments across the entire country, and we're always looking for the best risk-adjusted returns. So offering both debt investments and equity investments, or credit investments, it can be synonymous with that. That really rounds out our ability to invest in a lot more different areas in the country. So on our individual single family residential operations, we had a little bit lower occupancy for Q3. And the reason is that we stagger our lease expirations to primarily occur in February through June. And the majority of this year's expirations, they happen in June. So what happens is that when you start Q3, you have a lot of vacant properties. I think our starting occupancy was somewhere around 89% at the beginning of July. And then once those properties vacate, then you get them turned. And that takes a little bit of time because there's a lot of activity and movement and demand for trade services in those summer months. So turns can take a little bit longer. But kind of the quid pro quo of that is if a lot of people are moving out, that means a lot of people are moving in as well. So leasing activity tends to be quick. So we worked our way back up to just under 93% on our total occupancy by the end of Q3. But we did take the hit at the end of June for all those move outs that happened in July. So we had a 90.7% average occupancy. We had 106 leases started in Q3. About 60 of those were new leases and 45 of those were renewals of existing leases. And then we had a 19-month average lease term. So we don't write 12-month leases really. We go longer term. Usually it's in the 18 to 24 month range. The reason why it's a 19-month average is because we want our leases to strategically expire in Q1 and the early part of Q2. So if we write a 2-year lease in August, we're actually having that come mature in March time or so. The rationale behind that is you want a hot leasing season if a property is going to go vacant. So when it does, then you're able to turn it and then get higher rent because it is a more in-demand season for rentals. And then that's how we end up with that staggered expiration schedule. And then 76 of our leases are at above the pro forma rent, which is the anticipated rent amount. So about 75% executed at above the forecasted rent. So great performance there. Next, on the single family residential funds, we have about $17 million total invested in the SFR fund, and that represents the 47 properties that are in there. We have 17,000 investors in it and an average stabilized occupancy of 94.6%, which is right around industry averages for a seasoned diversified portfolio. Now, with that said, we started the SFR fund in November of 2023. So we're still stabilizing operations, but I think that we've been really performing extremely well on the fund. For it not being a mature portfolio that's not even a year old yet, to achieve 94.6% stabilized occupancy is quite a feat. In fact, at the beginning of July, we were at 92% occupancy. We had 37 out of 40 stabilized property. By the end of September, we were at 98%, and today we're sitting at 100% occupancy. So if you go to arrive.com and check out the SFR fund, you'll see the banner that says 100% stabilized occupancy. There's one property that's not stabilized. It's not leased yet, but we just bought that in October. So we do expect that to become leased during Q4. All right, moving on to vacation rental operations. We've had $679,000 of gross booking revenue from all of our operational vacation rentals in Q3, 1,400 total revenues, 38 ratings at the end of Q3, 38 total number of bookable vacation rentals, 25 VR markets, and a 4.9 star rating. So in Q3, we also had a new property drop, which was the Solano. It's a beautiful property in Scottsdale, Arizona. And we've also just released the buyer's home, which Ryan will go into more later, but I'll save that preview. I'll give you a little preview and save the story for when Ryan comes up. And then on our private credit fund performance, so this just launched in May of 2024. There's $16.5 million total invested by the end of September. And we've been generating an 8.1% annualized dividend yield since inception. 21 loans were added in the fund in Q3, and we have about 9,400 investors in that private credit fund. What's interesting about this one is just the volume starts scaling pretty quickly, and loans can pay back quickly. So the actual number of loans, in the fund right now is 43, but we've already had 20 loans pay off in the 5 months that the private credit fund has been active. So that means total, we've purchased 63 loans. We're closing on another 4 this week. So as some of you may have seen that we put the private credit fund max investment on it. the rationale for that is we're just really focused on getting high quality originators and contributing loans that we expect to have zero foreclosures, zero defaults, and even zero late payments. Intend to keep this great track record. So we haven't even had a late payment to date. So the credit fund is performing extremely well. It really reflects our kind of strict underwriting of each property, borrower, and loan. But the private credit fund has been doing quite well since inception. Okay, so some things that we're focused on. So with individual properties, first I'll talk about vacation rentals. So the tough part is that it's a it's a discretionary asset class because it's travel, it's vacation, it's not a consumer necessity like long-term rental housing is. So as such, we've been seeing a decrease in overall market demand in 2024 compared to 2023. Our seasonal beach rentals, they still performed extremely well in the summer months. They had about 90% occupancy. So no noticeable dip there. But when you're not in your seasonal high, we have experienced some suppressed demand this year. So to combat this, what we're really focused on is evaluating each home to ensure that's got an appropriate headline demand driver. And we're calling it the one reason to book. They're unique, cost-effective ideas that provide a differentiated experience to travelers. And for example, in Solano, it's a beautifully designed property, really cool aesthetic elements. And as we were looking at it, we decided, we need an additional headline amenity to kind of round out the experience. So what we're going to be adding there is a wine and painting room to the garage. Super cost effective and unique, and it's also consistent with the property. So we're going to put out some wine glasses, a nice little serving area, a large table for people to congregate around. We're going to provide easels and art supplies when people arrive for the check-in. So it's going to be a very intentional amenity and experience that people can really enjoy and have that differentiation from a hotel. So we're looking at all of our properties to make sure that when people are looking at the Airbnbs and VRBOs, that they see our property and it's beautifully designed and it's got that experience that you can't really get anywhere else, or at least it's convenient in the home. And that's what we believe will keep performance and bookings high, even through challenging demand seasons. And on a separate note, we're also internalizing 2 more of our third-party managed properties. So as many of you know, we have an internal property management company for our vacation rentals, Arrived Property Management, and we're bringing 2 of our Nashville properties in and currently are onboarding them, and we expect to have them launched next week on all of the vacation rental platforms. On long-term rentals, we're really focused on the competitive landscape for leasing. So as I've said many times over the webinars over the last couple of years, that rentals is a very seasonal business. And right now we're going into the low period, right? November through December is regarded as like the lowest part of demand. Now, as such, that's why we've structured and staggered our leases to expire from February through June. So even though it's going to be a challenging leasing season, we're making sure that we're priced appropriately, that we're putting concessions on all of our new homes. So the new leases all get $500 off the first month's rent just to stay competitive with the market. And then we're also waiving all application fees to encourage kind of a risk-free application for people to go through, just to see, if they qualify, then you've already won a big part of the battle of getting somebody in. So that's what we're focused on in the rental business. And then in our SFR fund, very similar strategies and focal points. We're sitting at that 100% stabilized occupancy, so it's a little bit less of a concern. But just maintaining that occupancy is most of the battle with long-term rentals. So happy to be at 100% stabilized occupancy there and intend to keep it extremely high. And then finally, on the private credit fund, we've seen really amazing investment demand, and we're really grateful for all the interest that the investors have had in it. So we're really focused on adding originators to our network and removing that max. So we want to make sure that our underwriting criteria continue to be respected, and that with any one originator, they could supply all of the loans that we need to satisfy the investment amounts within the private credit fund, but our underwriting criteria tends to be very discerning. So, we only end up buying a smallish percentage of the loans available from any one originator. So that's why it's important for us as we grow to have a good stable of originators, so we continue getting the cream of the crop that we see fit and continue that great performance. So with that, that's what we're working on, and I'll turn it over to Jake now for more insight on dividends and returns.
Awesome. Thank you, Cam. So we're going to talk about how all of that operational performance actually translates into returns for investors. And as a recap, there's two types of returns when investing in real estate. There is the dividends, which is the cash flow that's generated from renting a property out. And then there's the appreciation, which is the change in value of the investment. The dividends are considered realized returns because it's actual cash that's deposited into your arrived account every month where it can be reinvested or withdrawn. The appreciation is considered unrealized because we haven't actually sold the property and distributed those funds out yet. The value of the shares that you own may be higher or lower than the initial estimated value, but ultimately it's an estimate for now. And the actual appreciation will become realized when we eventually sell that property and distribute the funds to investors. The dividends are paid out monthly, so investors are receiving the consistent cash flow from each of their investments. Over the last 3 months, across all of our different asset classes, we distributed over $1.5 million to investors. And that brings us up to $7 million paid out all time. Dividends are really a big benefit of investing in real estate because you're able to lock in investment returns now, even while you're still looking for that long-term appreciation. This chart is showing the annualized dividend rate for all of the individual properties, vacation rentals and the single family residential properties. It's based off of the payments that they made in the third quarter. It's a good snapshot of current performance across, the wide variety of properties, even if it doesn't fully encapsulate the full performance since inception. Remember that when you make an arrived investment, you earn the dividends and appreciation based off of how that specific property performs. If you only invest in one individual property, you effectively have all of your eggs in one basket. You may end up investing in a property that crushes it by outperforming on rent and having minimal vacancy and expenses, but you also may invest in a property that has unforeseen expenses, which may cause us to lower or pause dividends for that property. Now, I've added in yellow the dividends paid by our two funds since their inception. So unlike the individual properties, the fund's dividends tend to be more stable over time because it's a collection of different assets. And so there's already kind of that instant diversification benefit because each fund has a number of different underlying assets. Our single family residential fund has nearly 50 properties in it. So if a property isn't rented within the fund, it doesn't have a material impact on the total cash flow that's generated from that fund. That's why the single family residential fund has been able to pay a consistent dividend of 4% every month since it launched last year. The private credit fund is similar since a big collection of different real estate loans. That fund has paid a consistent 8% dividend since it launched in May. Its dividend is nearly double that of the single family residential fund, but remember that it doesn't have an appreciation component the same way that the single family residential fund does. That brings us to appreciation, which is the other way that investors earn returns on their real estate assets. The appreciation component of the investment is realized and paid out when we eventually sell a property. And we'll get to an example of that in just a minute. While we're operating properties, we go ahead and we estimate the unrealized appreciation gains with a share price for each investment. The share prices are a combination of the estimated property value and all of the other assets and liabilities that on the balance sheet of the LLC. Now, here's a look at the overall financial performance for each asset type. The 338 individual single-family properties that were in operation this quarter had an average dividend of 3.7% per year. It's a simple average that combines our brand new properties with older ones and includes all markets. The average appreciation change for those properties was down about 2% over the last 3 months. You'll see that the single-family residential fund had that 4% dividend that we were just talking about. And then again, we see that the private credit fund has about an 8% annualized dividend. And again, while it's higher than the single family investments, that fund doesn't really have the expectation of appreciation. Now we're going to take a quick look at the total gross returns since IPO. So this chart is showing the combined dividends and appreciation for all of the individual properties. Importantly, this chart is not annualized. So properties owned for a longer time have had more time to appreciate and more dividends that they've paid out. The properties on the far left are around 0% because they've only paid out their first couple of monthly dividends so far. They don't have their first share price update yet. And I want to call specific attention to this dot over here. This dot represents the Centennial, which was the 18th property ever IPO'd by Arrived. The Centennial just became the first property owned by investors that we sold, making it the first property to go all the way through a full investment lifecycle. The Centennial is a 3-bed, 2-bath home out in the Charlotte suburbs. And we bought the home back in 2021 with about $120,000 from investors and a bank loan of $190,000. We secured a 2-year lease for the property before it IPO'd to investors, and then the same tenants signed an additional lease extension for another 12 months. So that means that this particular property had 0 vacancy until the sale process began in August. When the tenants notified us that they were going to vacate, we decided to evaluate selling the property. We did the normal repairs and improvements that we do between leases, and then we listed the property for sale to see if there was any interest. Though it's only been 3 years into the 5 to 7 year target investment period, we quickly found a buyer near our list price and decided to take the bird in the hand, knowing that at that sales price, investors would earn an average annual return of over 11% per year. The property closed earlier this month, and the sales proceeds have already been distributed to investors in that property. In total, investors ended up earning nearly a 35% total return over a 3-year period. And we can break that 35% total return into the appreciation and dividend components. Investors earned a 20% return from appreciation, which was 58% of the total returns. So the majority of the financial returns for investors actually came from the sale of the property. Investors earned another 14.5% in total from dividends over the last 3 years, which accounts for the other 42% of the total returns. So this property really ended up having a nice and balanced investment profile split between dividends and appreciation. If you had invested $1,000 in this property 3 years ago, you'd have ended up earning $145 in dividends paid out regularly over the 3-year period, and then another $200 paid out with the sale of the property, as well as the return of the initial $1,000 investment. We're really, really excited to have fully completed the investment life cycle for this property. And as leases end on other properties, we'll begin to evaluate and kind of make the case-by-case assessment on if it makes sense to explore a sale for that particular property. And with that, I'll pass the baton off to Ryan to talk about what's new with Arrived and what's coming soon.
Great. Thanks, Jake. All right. So let's talk a little bit about what's new, what we launched in Q3, and then look ahead to what's coming for the rest of the year. So Cameron mentioned that we launched the Buyer's House. This is a property that was featured in Stranger Things, the TV show, and the vacation rental team at Arrive did an incredible job of really recreating the entire experience, really inspired from the show. There are interactive elements throughout the house, and it's now live on Airbnb this week as well. And collecting rapid bookings for investors in the property. Anyone who's interested in investing in the property can do so. We have a max of $100 per investor this week, just to allow more investors to be able to participate. But would encourage folks to check it out, give us feedback on what you think, and we're really excited about how this turned out, and really being able to bring a one-of-a-kind experience to market, combining an experience in the vacation rental property alongside the ability to own a share and earn dividends from the performance of the property. Next, we launched the ability to log in through Face ID for our app on iOS. This was a pretty common request from frequent users of Arrived, where if they're logging in every day, then they may want an easier way to log back in. And so after a lot of testing, we finally rolled this out to all users on our iOS mobile app, and it's been working very well. We launched the ability to download a CSV of your portfolio performance. So for any investors who are wanting to do a deeper dive into the performance of all of their individual properties, they can download a data file from their portfolio page and slice and dice the data however they want. So we launched that in the quarter and have been getting feedback from investors, but just one more way to dig deeper into the performance of your own properties. And then following that similar trend, you'll see that what we have coming up is more iterations on the portfolio. We've launched several new views to add visual graphs and charting of the performance of things like dividends and property value growth within investor portfolios. And we plan to continue to iterate based on feedback that we're getting as we keep adding those elements, and then continuing to make more improvements to the portfolio, both through investors who are accessing their portfolio through the web on their computer and also through the mobile app, and more improvements coming there. So would love any feedback from investors if you have thoughts on the upcoming portfolio views, but more work to come there. We also are launching account statements. This has been something that investors have been asking for, that we've been developing, and the ability to just get a snapshot of your portfolio every month for your own record keeping or for other purposes. And then more iterations on the mobile app. A big one that we're adding is mobile app deep linking. This way, when we're launching new properties or new things and investors are seeing that through email, they can link directly to those elements on the Arrive mobile app. So that's a little bit of what's to come. If you have other thoughts on things you'd like to see, please feel free to add that in chat or reach out to the team. Always love to hear from investors what they'd like to see us working on next. And so with that, we can move into Q&A. Thanks for joining for the recap on Q3, both how we've been thinking about the real estate market, the returns and results from Q3, and then the product enhancements and things that we have coming up. Korin, welcome back. Thanks for kicking us off. Hey, Cameron.
Absolutely. Ryan and Cameron, thank you for prepared remarks as always. Absolutely love seeing the engaged chat that's been on with us for 29 minutes. So keep it coming our way. You'll notice that we're either answering in chat or doing a little bit of combo and throwing it up in the queue. Oftentimes you'll notice we'll group questions together if they're like kinds, or we will move through the queue. So they can go out of order a little bit. Keep me honest towards the end. If I miss your questions, we want to make sure that your questions are heard and you get an answer. All right, we'll hop back in here. The first one is from Ken, and Cameron, I'm going to kick this one to you. This question came from Ken when you were walking through leasing. Are there states that do not require tenants to sign a new lease after expiration of the first month to month within 60 days notice?
Yep. So there's not, to my knowledge, any state that requires a tenant to sign a lease in order to stay. Most leases are going to have a provision that speaks to the month-to-month rollover, and there's typically going to be a 10 to 15% premium on top of that. What usually is required by state law is that if you want to increase the rental rate, you have to send at least a 30-day notice in just about all places. Some jurisdictions are 60-day notice to be able to charge that rent increase. So from a process perspective, when we send renewals, it's simultaneous renewal options and a notice of rent increase wrapped into one letter. So that's how we're able to increase rents and comply with required state notice provisions. But on the tenant perspective, they don't have to say, I'm going to renew. We can send them notice to vacate as well. It doesn't have to be a notice of, rent increase and, they stay. If there's somebody who's had disruptive policy or disruptive behavior and the property manager recommends that it would be a risk to keep the tenant in, it's also conceivable that we would not intentionally, or we would choose to intentionally not renew that particular tenant. But the notice to vacates and notice of rent increases are the typical state mandated notices to give.
Absolutely. Yeah. Great question, Ken. Ryan, taking a step back, you had asked some folks for feedback on what they would like to see in the future. So I just want to pause for a moment. I know there was feedback in here about having auto invest in the future. So Brian, thanks for sharing that. We'll definitely be sure to share more. And then the other one is long-awaited Android, which I know we have a lot of folks that utilize that device, Cameron included. Just for context, and Alexa shared this in the chat as well, we released our iOS app not too long ago, and we're still working on building that out to the best of its ability. And then we will be able to start on the Android. But again, we're starting from the ground up on these apps and not relying on third parties, which gives us more flexibility to be able to make changes quicker and support our investors in the app in the best way possible. So more to come there. Keep the feedback coming, though. We are building for and by each and every investor on our platform and want to be sure that it aligns and is easily accessible. So Brian, any quick notes that you have on the feedback that we're seeing so far?
Yeah, thanks again for posting the feedback in chat. Alexa, our VP and head of product, is in chat as well, and seeing all the feedback, and definitely take that into consideration as we plan what we're developing next.
Absolutely. We so value your voices, so keep it coming our way. We'd love to hear the feedback. All right, a good one in here from Tim. Talk about the bubble and mortgage loans defaulting. What's Arrive's current stance and outlook in the real estate market? I'll kick this one to you, Cameron.
Yep. Yeah. So there's definitely talks of whether there exists a bubble or not, right? And, from my perspective, a bubble doesn't exist because one of the hallmark behaviors of a bubble is that it can pop. And when the bubble pops, the market loses all semblance of structure and support. And I don't believe that that's what exists in today's environment. If you time travel back, 16 years ago to 2008, man, 16 years. The start of that financial crisis was really from bad mortgages, as you allude to in your question, right? Mortgage loans defaulting. So the great financial crisis was really induced by the mortgage market. There was a lot of irresponsible lending that occurred. So one of the hallmark terms was a ninja loan, right? No income, no job or assets, and you can still get a loan on a property. So that created this bubble because property prices quickly went up. There was a lot of supply being added to the market as well, starting from the late 90s. So for a good 8 to 10 years, there was probably an overbuild of the number of homes in the country. But then the bubble kept growing because there were irresponsible mortgages to help support the purchases and the run up of the prices. So once the base legs of that house of cards started falling, then you did have a bubble pop, and then we got the great financial crisis, right? There was too many people that had properties that were overpriced and they were over levered and they couldn't support the payment of the mortgages. So a really high percentage of people had loans like that. And that's why I call it irresponsible lending. You could fault the banks, you could fault the borrowers, but overall there was a lack of systemic integrity across that market that contributed to the fault. That was largely cleaned up in the 2010s decade through a lot of different legislation. There's Basel 2, 3, 4 banking regulations. There's the Dodd-Frank Act, which really put a lot of more responsible lending practices in place. So, we had a run up of property prices. So now people have a lot of equity in their properties. Even if they lose their job, they tend to have a mortgage that's very low compared to the equity that they have in their property. So even if they fall into financial distress, they just sell the property, right? They don't have to be foreclosed upon. And there's not this chain reaction of defaults that are occurring because, once a property value starts slipping, then the comps start lowering. But in this case today, we're short on supply because we didn't build homes in this country for a good 7 or 8 years. Really, it wasn't until 2015 that building activity really started picking back up. So you have low supply, you have a lot of equity in the homes, and you have a lot of people that have mortgage rates that are serviceable, right? They're not these adjustable rate mortgages that, indexed to a level that people couldn't support the payments. These are largely 3 to 4% fixed 30-year mortgages that are affordable for people, right? So it's kind of priced correctly. So, our opinion is that there doesn't exist the conditions necessary to create a bubble bursting. You could certainly see price stagnation. And for the same reasons that prices didn't go down as interest rates were climbing up, we expect the inverse to occur, that as interest rates come down, sellers are going to start opening up more inventory, test their homes for sale, put them on the market. and that will increase supply, which has a downward pressure on prices. But then at the same time, as mortgage rates go down, you also have an increase in affordability because you have less interest expense that you have to pay. So net, we think that there's going to be a stable market. So it can feel that prices may be high, especially for how expensive mortgages are still. But it's, when you look at supply and demand, they're pretty much in equilibrium. So I think the markets are stable and will continue to be stable for the next couple years. But it's a big part of what we look at. So we always have our eye on it.
Absolutely. There's a relevant question I'm going to push to the top of the queue since you're talking about the current environment or what we could see in the future. So Corey had asked, if rates come down and there's an opportunity for strategic refinance on a home, would there be a return of capital to investors for the amount that was shifted to the loan? It's a great question.
Yeah. You nailed it, Corey. So that would be the use of those funds is primarily to pay back investors part of their investment equity. And then from that point forward, you would have leverage on the investment and then get the leverage impacts on appreciation. So that is part of our strategy. And one of the things I really like about a strategic refi is that it can be selectively applied. So homes that are outperforming and doing really well on their dividends, or they're in rapidly appreciating markets, you have a lot more information to make a good investment decision to lever that property. Whereas if you do it when you purchase, you have a thesis and you expect certain performance, but it's still unknown. Now we have a little bit of a track record, more information, and then can make better investment decisions when it comes to strategic refis.
Absolutely. Awesome, Cameron. Thanks for walking through it. Great questions. I'm going to shift a little bit to a different topic here around liquidity. So as folks know, if you're not aware, for our fund products, single family residential fund and the private credit fund, we have a redemption program in place, which I would mention is a semi-liquid option where the minimum is at least 6 months. And then you have a quarterly option to request to liquidate moving forward. But I believe Momoa is referring to liquidity for our individual properties. So Ryan, do you want to walk through if we have any updates on the secondary market approval from the SEC?
Sure. Yeah, I'll first mention that it's been a goal of ours to make liquidity options available for all of our products that arrived. We view real estate as a long-term investment and really working best when thought about that way, really investing and holding for the long term. But we also understand that investors want to be able to access liquidity if they want to. And we know that there's a lot of investors who may have missed out on investing in some of our older properties, maybe in some markets that we were more active in, a year or two ago that maybe we're less active in today that they want to get exposure to and want to be able to buy into those properties as well to diversify their portfolio. So we've been working for a long time to develop and qualify with the SEC a secondary market for investors to buy and sell shares, from each other on an ongoing basis. We hope that, so we've been making good progress on that. I think we'll have, a nice update for investors in the next few months. Very optimistic on the timeline that we have ahead of us right now based on what we've heard. And for investors, I just want to acknowledge that we've worked really hard to make sure that we're providing access to liquidity that's also, closely regulated and really following a tight compliance path. And so that's really why, we've spent so much time investing in that process to make sure it's something that's fully compliant and that can sort of stand the test of time as the Arrived investor base has grown really quickly. The number of assets on Arrived has been growing really quickly. And so we just want to make sure that, it's a robust process when we do launch. So more to come in the next few months ahead. But excited about the pace that we're on at this point and where we're at with it.
Absolutely. Yeah. So well said, Ryan. What I hear you talking about the most is that you believe that real estate is a long-term investment, but we also know that life happens. So flexibility is really that theme and accessibility for all our investment products across Arrive. So lots more to come. Always a great question. We'll be sure to share more as we have more updates available to you all. All right, moving back to the queue, back into leasing. Always a good one. This is from Gene. Has there been an uptick in tenants breaking leases early? It seems like this is the case for several of my properties.
We haven't noticed on a percentage basis an uptick in leases being broken. Historically, it's run at about 8%, and that's a pretty solid industry figure as well. And early terminations, we also think could be more likely given that we have 18 to 24-month leases. So even at my prior job in American Homes for Rent, about 8% of those leases terminated early, and that was on a 12-month lease schedule, right? So naturally, when you have an 18, 24-month lease, there is more time to trigger an event called an early termination. So we haven't noticed an uptick from that percentage basis, and we've been pretty consistent with that 8%. But sometimes random variability just gets you in the sense that whatever individual properties you invested, it may have impacted you on a statistically higher basis. And that's just kind of variation in chance. But portfolio wide, we haven't noticed a uptick.
Awesome. All right, moving back over to the queue here. Also, loving the questions coming in. I'm seeing our team answering a lot of those, but let us know if there's any clarification there. We're happy to jump back in. A good one in here from Julius. Can you speak to how competitive the private credit fund is as a source of funds compared to other options for capital? As you know, Cameron and Ryan, there's a ton of other options. So curious maybe what you both think on this. Maybe I'll kick to Cameron first, and then Ryan, if you have any thoughts as well.
Yeah, sure thing. So, I guess you could talk about the competition for capital in a couple different ways, but let's talk about it from the the lender's perspective. So, traditionally in the private credit world, private credit basically just means loans issued by non-banking institutions. So it could be coming from individuals, it could be coming from hard money lenders, it could be coming from direct private lenders. But that private credit fund space is one that has historically not been overly subscribed to, or it may have been difficult to find, or there have been less players within that space. But we see an increasing demand and a number of services providing that capital for originators. What that does is realistically, it will push the borrower rates down a little bit. And that is becoming a trend because with banking institutions having certain limitations because some of the Basel 3 and 4 regulations that I spoke about before, it requires that they have tighter liquidity components, meaning that they have to maintain a higher percentage of their banking reserves, available to be drawn out. So it can't be invested. So as such, a lot of lending within the traditional banking world is becoming more constrained, but that is fueling the growth of a private credit world. So a lot of the private credit beneficiaries would be real estate developers because their sources of capital have traditionally been kind of expensive unless it's been for a very traditional product like a 30-year mortgage, right? So a lot of those have always been available from conventional lenders, but the private credit space is really coming in to support real estate developers and entrepreneurs, which is the space that we're playing in. So, as such, it's, I think, really good for the industry to help provide better sources of capital to make sure that real estate projects are getting done and that the health of our real estate markets are in check. And you need good lending for that to be true because real estate is such a capital intensive industry. If you took lending away, you wouldn't really have many people that would be in positions to invest in projects and improve their neighborhoods. So we see it as a good thing that there is increasing access for real estate entrepreneurs to have lending options at more affordable rates. And, we'll continue in the private credit fund to pick the best of those opportunities.
Absolutely. Yeah, great question and response, Cameron. All right, moving back over here. A good one from Ty. Will the expected upcoming interest rate decrease this year and next year? What will be the impact to the private credit fund? Will the fund's yield be expected to drop Q4 this year and next year?
In the short term, we don't expect that yields will drop with our current portfolio composition. It's hard to project too far into the future because there's such a fast turnover of these loans. As I mentioned earlier, we've acquired 63 loans and 20 of them have already paid off in the 5 months that we've been operating. So as you're getting that frequent turnover of the note rates, we'll see what our originators are issuing the borrowers. but we haven't yet felt the significant, tick down in rates. It's more anticipation that in the medium term, there probably will be more capital available to borrowers in this market that could create competition that does drive yields down. But in the short term, and let's use your time frame of Q4 this year, we don't expect there to be material changes in the loan assets that we're purchasing from the originators.
Fantastic. Yeah, great question, Ty. I also shared a clip from a previous webinar where Cameron, I believe you walked through that too. So very similar and might have some more details in there as well. All right, a good one in here about private credit fund. So I'll kick this to you, Ryan. When will the 5K max per month be removed from the private credit fund? And Ryan, if you're open to it, maybe sharing a little context for folks that might not be aware of the max.
Yeah. So for folks who may not be aware, we launched a private credit fund. It's acquiring professional loans backed by residential properties. And as Cameron was mentioning sort of 2 questions ago, we partner with professional loan originators that are providing this financing to developers, real estate entrepreneurs that are renovating or building these new homes. It presents a really great yield profiles. The private credit fund's been paying an 8.1% annualized dividend right now. So it's provides a great yield profile for investors. And, we believe it has really strong risk-adjusted returns. These loans are backed by residential properties. The loan as a percentage of the value of the home is conservative, would require very significant declines in property price, more than 35 to 40% before there'd be even a risk of a principal loss on any one of the loans. And so it's a great, product that we've been excited to bring to market this year. We added a max investment of $5,000 per month while we're acquiring more loan supply for the fund. We've purchased over $20 million worth of loans for the fund already that we, believe set the fund up for a great success, and, really making sure that we're being conservative in terms of the types of loans that we're buying. We've also seen over $4 million or $5 million of successful loan payoffs already just in the first 4 months. And so really kind of getting a feel for the cycle and pace. But going back to, the current max investment per investor, we really want to just make sure that we maintain a really high quality bar for the loans that we're acquiring into the fund. We're very conservative on what we buy based on, the locations and markets that we're investing in. We want a lot of margin for safety in the loan as a percentage of the value of the property, the loan to value. We want experienced borrowers with a track record of, experienced projects. And we want, investors that have their own access to liquidity and capital invested in the deal, and to continue to invest in the deal if it's required to make sure that they get to a successful outcome. In the meantime, we're also developing more relationships with loan originators so that we can get access to more loan supply. So that's why we've added the max. It just allows us to be very selective in what we're investing in, make sure that we maintain the current rates of return in the fund, and that we, are being kind of cautious and conservative in what we're investing in.
Ryan, when you talk about being conservative, we've done that across all of our different assets to date. When we're thinking about markets or different properties that we're bringing on the platform, and then it's moved over into loans and what we've chosen to acquire as well. So definitely appreciate you walking through it, and a great question. All right, I was trying to finish in chat before, so I'm going to leave that there, but I'll come back, Michael, with my thoughts, and I'm going to move back over to the queue here. I'm going to kick this one to you, Cameron. What happens when properties are sold within the single family residential fund? Obviously, today, Jake had walked through Centennial, which is an individual property, which is different. So curious your thoughts here.
Yeah. So the fund is fundamentally different. Is fundamentally different than individual offerings, in that with an individual offering, once that property is sold, there's nothing left other than a bank account ready to distribute the cash that it has in it. With the fund, it's an open fund structure that continues to live on independent of the assets underneath. So let's say, there's 47 properties currently in the fund. And if we decide to sell one of them, what you're basically doing then is taking an asset and turning it into cash. That cash sits in the fund and it can be redeployed, it can be paid out, it can be used to fund redemptions. There's any number of things that you could do with the cash. But the punchline here is that that value stays within the fund. And to the extent that we need to use the funds for various things, investor related, we'll do that. And if there's no redemption request and there's adequate amounts of money to purchase another property, then that's what we'll do. So basically, you'll be switching out properties. You're invested in the total performance of the fund, not any single individual property. There's an LLC at the top called the Arrived Genesis Fund, LLC. And then there are 47 properties whose owner is that Arrived Genesis Fund. So when one property underneath is sold, you just convert it into cash to be done, with X, Y, or Z activities. Most likely it would be to purchase another property and get it reinvested. And this is the process of rebalancing a portfolio, right? When you're, carving off some assets, you want to turn them into cash, you want to deploy it into, say, another part of the country that may experience some growth. Let's say that there's some natural resource that is found in an area. There's going to be a big boom town in somewhere in central Arkansas. Okay, let's sell some of the areas that we can take the appreciation on, rebalance the portfolio, and then reallocate the money. So there's a lot of options within the SFR fund, but the primary difference is that with an individual offering, once the property is sold, there's really no assets underneath other than cash to be distributed. SFR fund has ongoing options depending on what the needs are.
Yeah, and Cameron, you might have mentioned this, but just in terms of how investors realize that they'll either see it in the form of an increased dividend or distribution when the property or properties are sold, or increasing share price. If a property has seen 30% or 50% appreciation and then is sold, then when we go buy an additional property, we get to buy 1.5 properties for the same original invested capital instead of just one property. So either through increased distributions or increased share price is really how investors in the SFR fund get to kind of realize the benefit of that appreciation.
Absolutely. All right, moving back over here. Let's see. Oh, this is a good one. I think this one has popped up on almost every quarterly financial webinar. It's always a good one with climate. It's from Oscar. How does the bill that was passed by the Senate in regards to single-family residential properties being used as investment properties by individuals or companies affect Arrived and its investors?
Yep. So if we're talking about the same bill here, which to my knowledge is called the End Hedge Fund Act, Control of American Homes Act. It's a long name, but it's something to that effect. And I don't believe it's been passed yet at any sort of federal legislation level, but there's certainly a lot of talk surrounding that bill because there is a housing affordability issue in America, especially because, for the points I mentioned earlier, we're low on supply and we're high on interest rate. That's not a great combination for home affordability. Part of the proposed hypothesis of solving this problem would be to limit the amount of investment that any one entity, hedge funds, private equity funds, public companies, big REITs, et cetera, could own to help mitigate supply issues. It's a bit of a red herring, in my opinion, just because the total size of the U.S. residential market is somewhere north of $30 trillion. And institutions that have, call it a couple of thousand homes or more, they own something like 3% of that total market cap. So the overwhelming majority of property values are still owned by individuals like you and I, or, maybe small investors that, traditionally have one or two rental homes. So as far as how it would impact Arrived and kind of the industry in general, if it were to pass, I think that Arrived has a very flexible model that is fairly unscathed by the proposed legislation. So our SFR fund is 47 properties. And if it did pass where you couldn't own more than 100, Well, there's Genesis 2 fund we could create. There's Genesis 3 fund. So there's any number of divisible units because we've really specialized in being able to offer investments at a very small atomic unit level, which is the individual house. And that's one of our most popular products. So we could continue business as usual because we create an LLC entity that holds one asset for individual offerings. So it would not run afoul of the proposed legislation as it is. And even for our fund products, we can create any number of funds once we hit that 100 unit threshold. So Arrive doesn't believe that we are kind of the intended target for this type of legislation. Some of the big REITs that own 60,000 or 100,000 units, they're more squarely in the crosshairs of that type of legislation. But it hasn't passed yet. It could go through rounds of modification. It may never pass. But there are other industry players that have large portfolios rolled up to a single company that are certainly at more risk than the way Arrive has structured itself.
Absolutely. Yeah, definitely a great question. We'll be sure to share if there's any updates there that would impact investments at all in the future. But appreciate you walking through it, Cameron. All right. A good one from Michelle. Can you use private credit fund to temporarily avoid a late payment on behalf of a client to keep them current?
Yeah. So the private credit fund owns the loans that the borrower, has the obligation to pay back. And if they're late, then the credit fund has an interest in working with the borrower to make sure that they can get to the finish line, because ultimately we want the borrower to be able to complete the project. So to the extent that the levers that are under the creditor's control would be, when do we initiate a default process? Can we restructure and modify the loan agreement to defer some payments so they can maybe accrue the interest and the liability, but not have to pay it out on a monthly basis? Those are options that we could select as the creditor. So the private credit fund and its investors are not really a stopgap for the borrower paying. You want them to pay because they're the ones that fund the interest payments for the dividends. But we do have the option to work with them, and getting to the finish line is the most important end goal, because then they're able to pay back the principal, the interest, have a sale on market, and they would still accrue any sort of penalties, fees, and interest that they owed. But we could choose not to go and foreclose on the property and try to take it back.
Wonderful. Awesome. Good question, Michelle. Definitely appreciate it. Some great feedback in chat from Nick. Thanks all. This was very informative. We definitely appreciate you joining. Cameron and Ryan, I know we're getting close to time. We have a few more questions in the queue. Do we have a hard stop, or are you all good to keep going?
This is the main event. Let's keep
all right.
going.
We'll keep going. Awesome. All right. A good one from Jules. If you are an investor in the single family residential fund, when a property is sold, do you benefit from the proceeds of the sale, or is it only the people that invested specifically in that property? Felt like this was a good one to chat through live. Cameron, you briefly walked through what it looks like if there's a sale, but just to double down for Jules.
Yep. So when you're invested in the SFR fund, you're a beneficial owner of all of the assets within that fund. So currently today, it's all 47 assets, and you just have a smaller proportional stake because they're $17 million in the fund, roughly. So if you have, an investment in that fund, the denominator is 17 million, and whatever you own in shares is the numerator. So you're always the beneficiary of any sort of economic activity within the fund. But typically in that fund structure, it's just going to be a smaller percentage of ownership of a larger pie.
Fantastic. Awesome. And I know folks are asking, I think, for cutoff for dividends for both the single family residential fund and the private credit fund. Correct. The cutoff would be today. If you are looking for a dividend payment, that would be around December 25th. Again, that'll be around December 25th because that is a holiday. So anytime there's a holiday, it's likely a day or so after that takes place. All right, moving back over here. A good one from Jesse. It seems like there are a bigger push for employers to return employees back to office. As we know, Amazon is one of them in South Lake Union and Seattle. Would this be a factor in selecting more urban SFR in the future? Cameron, I'll kick to you.
Yeah, I think that there's definitely that possibility. And I would probably say that it's more urban housing in general. It may not manifest itself as an SFR because it's really a function of the land price, right? So as you get to urban areas where land values go up because there's less available, there's less zones for housing, then the cost of that land does go up. So it would make something like a single family residential, single lot house on a 6,000 square foot lot not as economically viable. So I think that opens up multifamily investments that could open up 20 unit apartment buildings as the demand goes up for those. But it's going to be also very regional, right? So would that increase the appetite for us to fund certain multifamily loans in Seattle for Amazon? For sure. Like if you can anticipate that the demand will be there, then say, okay, I want to invest in X location, but what is the best way to invest in it? So if you wanted to invest in a home, just because Amazon has return to office doesn't mean that there's going to be options available to invest in rental homes that are going to be the beneficiary of that area. But you could have conviction in lending on a $5 million apartment building that is needing some sort of renovation in South Lake Union. Then that's a perfect debt investment to get into on that type of news. So we look for bullishness and we look for areas of growth and then determine what is the best way to play that opportunity. And I think for urban areas, the biggest beneficiary would be probably some sort of multifamily housing option.
Absolutely. Yeah, definitely appreciate you walking through. It's obviously very pertinent when we've seen these large corporations returning to work and obviously impacting the economy. So always a good one when you're thinking about other options for real estate in the space. All right, moving back over. I think we only have one question left in here. Very pertinent given the current climate that we've seen with hurricanes. How have the recent hurricanes impacted Arrive portfolio? Is there an increasing risk in this area? It's from Diego. Cameron, I'll kick over to you.
Yeah, a very pertinent question. Insurance is probably the biggest way that we see the impacts of hurricanes, natural disasters, climate change in general. Fortunately, none of our homes have really been materially affected by any of the hurricanes that have happened thus far in the season or in the past. There haven't been any sort of total losses or kind of catastrophic damages to any of our properties as a result of these types of events. We've had small things like a tree knocking out part of a fence that we had to repair, or some leaks from really heavy rain. But in general, we have also avoided areas like Florida. We have a couple of investments in there, but generally our long-term rentals haven't been oriented around there because the fixed expense structure of the insurance has been difficult to overcome in terms of making a cash flowing investment work. So having that discipline on the underwriting, saying I need to be able to achieve a certain yield before we're going to purchase these properties, has really kept us out of areas that have been prone to these types of issues. And we proxy it through the insurance price for homes. So even though our homes have not been directly impacted by the hurricanes in any sort of material way, they have a secondary indirect effect because the whole insurance industry is kind of connected, that's kind of independent of state. So, insurance rates overall have been going up, and that has been forcing us to avoid certain areas. And it's been very in our face because, say, for example, Florida has an insurance price that's about 7 times higher than our average property in our portfolio. We'll pay about 35 basis points of value per year for insurance value for, an average non-risky place. And then in Florida, it's about 2.5%. So those differences are very material, and fortunately, they kind of kept us out of trouble by having that cash flow discipline. But yeah, no large impacts to date, but it'll continue to impact the insurance industry as a whole.
Absolutely. Yeah. Very well said, Cameron. I would say too, I know part of the process with your team, Cameron, is working closely with those third-party property managers, staying close to the news about what's coming down the pipeline. So then those property managers are preparing the tenants and making sure that they're safe as well in what can be a very scary event. So definitely appreciate you walking through. For folks that do have properties perhaps in those areas, we always send out updates. And then if there's ever any damage, we would also communicate any at that point as well. So just so you know what to expect from an investor standpoint. If there was, we would also showcase that within the performance tab on that individual property page as well. All right. I think we cruised through most of the questions here. I asked folks to keep me honest if I missed any in the chat. I'm human, so that could definitely be. So let me know there. But Ryan, I'll kick it to you first, and then Cameron, if you have any closing remarks before we shut our virtual webinar doors today.
Yeah, I'll just say thank you to everyone who joined in for the webinar and for all the great questions and feedback today. Thank you, Korin, for leading us in the discussion today, and Jake and Cameron for updating us on the Q3 performance, and then the Arrive team in chat. This has been a fun way to get together with all of our investors this quarter. Reach out if we can be helpful, and we'll see you next time.
Yeah, very much echoing the same statements as Ryan. Check out the private credit fund. I've always got this thing marketed behind me. Love that investment product. I think it's a really great opportunity. And also check out the buyers we should have the Airbnb listing up as well. So if you are interested in a spooky stay, the calendar is currently open, accepting reservations. So check out the buyers for both a stay and an investment.
Absolutely. Love a spooky stay, especially on a spooky day. So, Ryan, thank you so much for your time and prepared remarks, and Cameron as well. Always exceptional walking through all the content, and Jake. And then for everybody on our team and chat, thanks for being so active with the questions and engaging. And most importantly, our investors that are new, learning, existing, we so appreciate your engagement. Absolutely exceptional to see folks here for an hour 8 asking so many diverse questions. So keep it coming our way. I hope you all have a great rest of your day, and happy investing.